Today's number is 65. That's the percentage chance of a Federal Reserve rate cut in December as of right now. And it may not seem too surprising until you look at where it was just 24 hours ago. So what did Jerome Powell have to say about the economy that started to spook the market? And why has it not led into any selling just yet? Well, the short answer is that earnings are kicking ass like we thought they would. 85% are beating expectations, and we just had three massive ones: Google, Microsoft, and Meta. We'll be breaking down everything that you need to know about those, along with some charts that maybe aren't looking so hot right now, but could on the horizon. Don't go anywhere. There's a lot to discuss as we cover stocks, commodities, and cryptos together for the Daily Show. See you soon. Well, welcome back everyone to the Daily Show. My name's Thomas Atkinson, and in today's video, we'll be covering the macro, the data, the key levels, and of course, the options flow right now because Wall Street's been at it again over the last 24 hours, and there's a lot to talk about. Now, the markets were doing well in some of the sectors we've discussed recently, but it was another day of poor breadth across the board, with many areas actually down as markets do limp higher. And what this has people worried about is, of course, concentration. As we see big tech stocks get bigger by the day, Apple now 4 trillion, Nvidia now 5 trillion, it makes us wonder whether we're in one of those dot-com bubble booms. And I thought I had a quick question for you in the comments down below of where you feel like we are right now. And this one's from Heisenberg over on X, and I thought it was pretty funny because obviously he's got teams for the different areas of the bubble. And you can also say X if you believe we're not in a bubble. But you can see here, guys, team A, B, C, D, or E. Which one are you on? I'm going to assume a lot of you are somewhere around D or C at this stage, but it will be interesting. And of course, we'll have a look at what the market synergy looks like later on in today's video. Let's kick things off here with Powell's speech. We've got a cool little thing here from Blue Kurtic. And basically, what it shows is that there was a massive decline over the point where Powell kind of started to mention things about tariffs. But really, he basically indicated that the December rate cut may not happen. It went from being like an 85 to 90% chance to 65 straight away. And although the markets did drop over that, of course, then we got those fantastic earnings, particularly from Google, that have sent the market saying, you know what, it's just a Goldilocks situation. We're going to keep going up. So where were the problems? Well, the main thing is, of course, what's going on with inflation. And we've got a cool chart on that coming up in our next video where we look back at the 1970s. We've got some overlays to show you guys, which will surprise you. So make sure to subscribe for that. But also market expectations, which of course did end up changing a little bit. We saw a 9 basis point change on market expectations over the next 12 months, basically taking out part of a cut. And the Fed's decision, obviously based on the poly market, you can see here, crashed in terms of the percentage overall. Now, it could just be Jerome Powell trying to stop this market from going up so much. But for now, it is just bullish, bullish, bullish in terms of what we're seeing. So what about a cut at the top? Should we be worried about the fact that they are cutting? Well, you can see the last couple of cuts. We had a few little pullbacks sometimes, but mostly the trajectory was good. And you can see here that when we get cuts at all-time highs, such as what we just got, well, they do tend to be very bullish. This one here is from Ryan Detrick, and you can see the next year, in all situations similar to this, going back into the 80s, was actually bullish over the next 12 months. Now, I'm not sure about the 12-month stat, but what I do like is the fact that, yes, it does line up very well with what we've been discussing on this channel, which is actually a pretty decent run into the end of the year. And we'll talk more about that as we bring up Wayne's details soon. Let's talk about gold down for 3 days in a row. Now, we had this in our last video along with some silver stuff. When markets crash like they did on gold, which of course we did expect based on everything we were putting together, then eventually they find stabilization points. Now, we've sold off 10%, and this was our case. Between 10 and 20 is basically our case. 30% if we go into a proper crash, and then I think gold will actually come out pretty strong from that. But 10, 20%, that's kind of the normalized pullback in what has been a pretty epic run. Now, we've done 10, and when we've done 10, generally 2 months later, we are positive 100% of the time. Now, this is Subu Trades data. We've also got some that we shared in our previous video. Check it out after this about silver, and it was pretty bullish indeed. And what we've actually been seeing is a pretty good sell-off in silver as well of the tune of 16%, which hit the daily 50 moving average. Now, there are reasons why we believe gold still has more in it. It seems to be tracking other bullish markets. It's kind of similar to why we still think the S&P might have a little bit more left in the tank, and it's because it's tracking some of the most similar markets. One of my favorite things to do is to check these things out. Now, we expected pullbacks because we often get them around this period here in previous times, and we do expect that, that we're probably online for, I would say, more the 2000s run. So I've said before that I think by the end of the decade, maybe early 2030s, we're probably going to hit a 7,000 plus on gold. But in between then could be very volatile. So we need to remember that. Now, we did share this trend line here in the previous video. And the main reason I'm bringing it up is just to do with the fact that, of course, you guys mentioned in the chat that then in the DM comments that I didn't mention the gaps. Now, it's not that I don't think the gaps are important, but often you do get gaps coming out of the gates and they don't have to fill straight away. Remember, gaps are cool for trading methods, but at the same time, it doesn't mean it's going to fill straight away. So what's happening at the moment is markets keep pressuring a squeeze. And we're seeing this in the options flows, such as what we've got later on, where if we now break 6,900 properly, then we usually will go towards 7,000. So if I'm going to predict like a temporary top, of course, I'm going to do it round massive call walls traditionally. And we're only at like semi-big call walls. 7K is going to be probably a more important one just before that. Now, what about some signs of internal weakness? One of the things that a lot of bears are talking about is, of course, breadth. And breadth has kind of sucked a little bit recently. Now, you might say that's bad, but remember, we're being driven by tech, by AI businesses that are feeding themselves like giant worms, guys. They're feeding themselves and they're doing some kind of like, I'll give you money, who gives you money, that gives you money, that gives you money, that comes back to me, and then I call it growth. Now, that is a weird thing, but that's exactly where we find ourselves in 2025. And I'm sure you've seen the memes on it before. So here we have, of course, the low for equal weight S&P financials versus S&P. And you'll notice that the market is kind of hitting a very critical point here. Now, this is nothing new to anyone who's been watching the channel. We've already talked about how financials have been weakening versus the SPY for a while. And that tells us we're through the mid-cycle. We're lightly in the late cycle. Now, some people think it's early cycle. I tend to go with more of a later one, which can take 1-2 years max kind of thing. So let's have a look here at S&P 500 and the equal weight market. That is at a 22-year low when compared to the SPY. Again, a sign of the times. Big tech rules supreme. 46% of the S&P. All the gains come out of top 10 stocks. That's kind of where we find ourselves. And that's okay for a time until things go bad. So what we're starting to again see is the breadth. You can see here the divergences of the breadth between the markets and stuff. And actually, I didn't know this stat, but supposedly it was like one of the worst up days breadth-wise ever. Walter Diemer obviously shared this. I think it was like 20 years or something before we last saw something like this. So that's crazy when you think about it. The advanced stocks was only 1,053, 1,717, but the way we moved up and we had this terrible breadth, it doesn't kill a bull market, but it certainly does tell you kind of, again, there could be some worrying signs underneath. And remember, even in 2007 and 8, the worrying signs started to appear in 2005. So in my opinion, things like CLOs and these other things we've talked about on the show, they're a problem. And they'll eventually become a bigger problem. But again, timing will be everything. For now, what are we looking at? High beta versus low volatility. Take a look at this one here from Trend Labs, and it is absolutely skyrocketing. So cool code, certainly when it's going, you don't really want to be bearish. And again, when we've had such a strong year, we do tend to have very strong November, December, January. And we actually saw that in Wayne's details here, which found that 39 out of the last 40 situations were actually bullish. So generally speaking, you want to be more bullish than bearish when it comes to looking at these markets into the end of the year, which we've talked about before. So we're kind of looking at dips being purchased, and we're looking at people getting into the markets we've never seen before. Remember, when people get into the markets that you've never seen before, e.g. maybe a cousin calls you and he says, hey, dude, you heard about this thing called the S&P? Let me know in the comments down below. I want to hear those types of stories. I've actually had some myself. People that didn't know anything. They like, I just heard about the S&P. Is that good? Wow. It's scary. It's scary when people like this are coming into the markets because that's getting closer. Speaking of which, where are we in terms of an AI historic to .com kind of boom? Of course, we find ourselves here. Generally speaking, there was a little bit more to go. If we had to guess, then that would put us probably at a January style pullback, somewhere around there. And then, of course, we may peak somewhere in 2026, 27. One of the big problems, I think, is not so much that earnings aren't great. It's that we're getting this massive switch between EPS and the price action itself. So that'll be something that, of course, we continue to watch. But do remember, every time these EPSs are beating, look at this pace and look at exactly how it's going so far. So duality research here, you can see it's literally doing everything. The snake charm has got it there, and it's been played up. Google had a stellar earnings, it looked like to me. And it was just more along these lines. 87 now, 85, 86% beat rate. It's a strong earnings season. And you do not want to go against strong earnings because the market loves being optimistic and pricing in forward. What it does, it takes one of these and it goes, what if things could be even better? What if we could have even more, guys? We're going to put even more in there. That's exactly what is happening at this stage. They're upgrading for next year. They're dancing around forward projections in the Excel spreadsheet. The AI is, figuring out what's going to happen in 10 years. And of course, that's leading into it. Now, I did post this one here from App Economy Insights over on our X account. Links in the description down below. And what I was very happy with was Google's result. Total revenue up 16% year on year, 2.2 billion beat. Ads was up 13%. Search was up 15%. YouTube ads was up 15%. Subscription services up 21%. And cloud up a staggering 34%. So it was a monster. And you can see here all of their little arms. And one of the thing about this one is, when they've added Gemini into Google recently, I think it's going to eat ChatGPT's breakfast a little bit there in terms of the general user. What do you guys think, though, in the links in the description down below? Now, Meta was down about 7% after hours. Google was up about 6-7%. It was a little disappointing. Obviously, it was still good. I mean, these are still great numbers. Same with Microsoft, but the markets expect a lot. So generally, I would say it was a neutral, but generally speaking, pretty decent beat across the board for these ones. Now, what about moving forward? Well, we've still got the Super Bowl or the World Series here for earnings because we've got Amazon, we've got Apple, we've got Coinbase. Exciting times for these. So another couple of stocks. And do remember, these are going to be big. The options market thought it would be plus minus 6% for Google Meta. Pretty much was after hours. That's now hundreds of billions sometimes in movement. Amazon's going to be plus minus 6. Apple's going to be around plus minus 4 according to the options market. It's going to be some blockbuster stuff. So again, we'll have a breakdown of all of that fully after the close. Let's now take a look at this advanced decline line. Still looking okay in the markets. You can see we're pressuring these highs. It looks like we're going to break through them, which again should push us towards 7K. And if that happens, then we're looking for an extreme overbuy. Now, we haven't had an extreme overbuy for a little while. The last one was in September late. And then before that, we kind of got one maybe around here in July. And the market just kind of started to go sideways. An extreme overbuy will probably give us sideways to down. We haven't found one of those just yet. So for now, the markets still kind of keep grinding. Here are the options high, low levels today in terms of where the market expects to be going. And it doesn't matter how you break down this market right now, it's very difficult to want to be bearish on it when it's going up like this. A lot of people are talking about those gaps. The problem is the gaps will not give you a sell signal. So we go here to the options market to understand where it could be going towards. Now you can see there's a bit of 69.20 here in the next 24 hours, but 7K does rule supreme on so many different options expirations. So I think that's really important to note. 7K is going to be kind of one of those magical numbers for this market. Tesla's through positive gamma as well. 450 plus is still pushing Tesla higher. Had a little sell and rebound. Nvidia's in positive gamma. Again, above all the call options. So we're moving higher here. It was one of those ones we thought would be good. I'll give you congratulations if you're in that or in Tesla or anything. Well done to you guys. IBIT here, you can see for Bitcoin's a little bit different. It seems to be all over the place, but 60 is going to be an important point for IBIT, and GLD is going to be 360. 360 is going to be that put wall. So we're getting closer to it again. As we rallied, we're selling. Maybe we go a little lower, hit that daily 50 moving average. That'd be fantastic. 38.50 for gold, then maybe bounce up. Let's now have a look at the charts and the leading indicators. First up, yields. So you can see here yields spiked as soon as Jerome Powell said, oh, yeah, we're not going to probably cut in December pretty much, guys. And that made people take a little bit of a pause. I always say if it's in the press, it's in the price. I'm not that interested in what Jerome has to say because the Federal Reserve, look, there's a statement. They're always behind the curve. So I know everyone sits there and they follow them and they say this and that. But here's the question. Do you even remember what Jerome says 2 days later? The answer is probably you don't. So therefore, it doesn't matter. And we've actually been glossing over this for a long time because we ignore it because we end up doing better following the flow. But a lot of traders hate that because they want to understand. They think that every day must be understood for the move in some kind of logical fashion instead of thinking about it as a bigger picture, a bigger thievery concept of where the Wall Street, AI and boffins are stealing your money basically by pushing certain psychological barriers and, of course, using the common press concepts that you're hearing to get you. So if you're a believer in that, check out our courses, particularly the advanced course or day trading masterclass. You'll really enjoy those. They'll help you understand how to do better in these markets. Now let's have a look over here at what's going on with the bonds market. It's not caring. It doesn't seem to be too worried. While yields were up, they didn't break any technical that really looks too worrying. But I just wanted to note here that Google was a classic case of human psychology. It's a clear flag, yeah? And it's obviously had a clear run into it. Now, a lot of people didn't want to take this because they thought, oh, Google's too high, it's run too far, the flag won't work. Well, this probably is going to go up another plus 6% or something tomorrow. It just shows you, even if it didn't, it just shows you again that this is a break-even position at worst now. And it happens time and time again. This is one of the biggest stocks in the world. Imagine what's happening in some of the other ones. There's so many opportunities out there every day, guys. That abundance mindset. Dollar index did break a little bit bullish for me, so I'm pretty happy with that and got up here to the 99 kind of 80 area would be nice. And yeah, again, if we're going to see less cuts, that's going to be stronger for the dollar, at least initially. And you can see here gold has now kind of seemed to discover the 4-hour 20 moving average. So this has been a pretty key level. You've got selling off the 4-hour 20 here. You've got buying off the 4-hour 20 over on this side. And we have, of course, not really found necessarily a base just yet. I'm looking for the daily 50 on gold. I'd like to see 38.50. We obviously saw 46 on silver, which was an excellent level. And these sell-off levels are around where you start to think about basing. 16% off on silver is about right. That's between that 10 and 20. And same with gold, we hit the 11%. So we're between 10 and 20 now. US oil, what is going on here? Well, oil has, of course, rallied to the first level supply, sold off, and now we'll see whether it rallies again. Now, funnily, the oil stocks were doing pretty well. So we'll see whether it can get through this, but that could become an inverse head and shoulders. 62, 60, 63 level of barrel. That's going to be very strong for oil. So we'll be watching. Tesla dumped and then rallied. Again, that's strong because it's holding above 450. I'd like to see it come out of the gates bullish tomorrow. I'd like to get it above 470. Why can't we get above 470? Semiconductors, if semis are up, we can't be bearish, and semis are up. Semis are beating the SPY, and NVIDIA is bullish. So you can see here, it's rallying at this stage. Now, it was a bit of a nasty candle because it ended up as a doji, but look, it's up so much now, even if it consolidates, people are going to be pushing that narrative of getting it back to that 45 PE ratio forward, and that's still far away. I think that works out to be like a 240, 260 or something like that on the price. Chinese markets are up, bullish, guys, slowly kind of getting up there. There's a couple of good single Chinese stocks that we've got in our community watch list for members of our Market Masters Club. Links in the description down below that have been doing all right. And NASDAQ pushed a new high, which basically means it's going to go to an extreme overbuy. So similar to the SPY, it looks like these markets are trying to really squeeze out a lot of shorters that might have come in recently. And that is, of course, why they do tend to push this way. Now we'll look at Bitcoin. This has definitely been the disappointing market for many, but I think it's because it's coming to that really important time. Are we going to see the end of the Bitcoin rally during the halving cycle or beginning of a new one? It probably all comes down to the 116,500, or if it wants to sell off first, maybe a 98, 94 kind of K and then rally up. Some people also can note here that we may be looking at some kind of inverse head and shoulders, which again, 116 would be a very strong break for it. Certainly focused in on Bitcoin. I'll give you guys an update if I see anything there. Guys, it's been an eventful week. Jerome Powell didn't really have much to say, in my opinion. I think he's just trying to shake everyone out and try to stop the market from being like cut. He's always been like that. But what I do think is, of course, inflation could be coming back, which we'll continue to watch. Make sure to sign up to the newsletter. We've got a special coming out after the close tomorrow. So that's our weekly. Links in the pinned comment and description. And of course, follow us over on X. Check out our courses, Day Trading Masterclass, Advanced Class, if you're interested in finding out a little bit more about what we do and our other stuff. And obviously, it's great to have you here. So thank you so much, guys. We'll see you in the next video. And it's exciting to be in the markets in 2026. I don't think it's going to be any less exciting. It's going to be even wilder. Bye for now.